Hello and welcome. In this lecture video, I'm just going to review this accrued revenue problem again, and then look at some practice problems. Okay. So again, what we're talking about with accrued revenues are revenues that are earned in the period, but they're not yet recorded. So we looked at this example on the 12th. Fast Forward agrees to render consulting services. So they didn't get paid up front. They haven't gotten paid. They're going to get paid January 10th of the next year. So from the 12th to the 31st, we have 20 days. So they've earned 20 days worth of revenue in accounting period 1 in this first year. And we have to recognize that. They've earned that. Even though they haven't got paid, we still have to recognize that as consulting revenue because they've earned that revenue per the revenue recognition principle. Therefore, we should recognize that in the period in which it's earned. So I don't debit cash because they don't get cash until the next accounting period. So I debit accounts receivable, and then I credit consulting revenue. On the 10th, when they get paid the $2,700. So we debit cash. When we get paid, we debit cash. And then we credit the accounts receivable because, well, they don't owe us money anymore. Accounts receivable is an asset. How do I decrease an asset? With a credit. That's why it's credited. And then I credit consulting revenue for the $900, which is the 10 days, $9 a day, or the $2,700 minus the $1,800 gives me the credit to consulting revenue for the amount of revenue that they have earned in this accounting period, which is $900. Okay? So I hope that clarifies that. I know that the video kind of rushed through this problem towards the end of the other video, so I wanted to make sure that we went over this one in more detail now. So now let's look at some practice problems. So here's what I want you to do. I want you to pause the lecture video, and I want you to do number 81, number 85, and then number 94, and then I'm going to go over 96 right now. It says an account linked with another account that has the opposite normal balance and then subtracted. It's a really long way of saying it's a contra account. So remember the contra asset account? Contra asset account, for example. Remember accumulated depreciation? So remember what we do is we say asset cost minus accumulated depreciation gives book value. So an account that is linked with another account, accumulated depreciation, machinery is linked to the asset machinery, has an opposite normal balance. What's the normal balance of the asset machinery? A debit. What's the normal balance of accumulated depreciation? It's a credit. Okay. And then it's subtracted from the balance sheet of the related account. So it's subtracted from the asset account to give us book value. That is the contra account, such as accumulated depreciation. Okay. So I want you to pause the lecture video now and do 81, 85, and 94, and then come back, and then we'll check it. Okay, so let's see how you did. So number 81, prepaid expenses, depreciation, accrued expenses, unearned revenues, and accrued revenues are B, all items that require adjusting journal entries. And that refers to that framework that we talked about in the first lecture video for chapter 3. Remember, those are all items that require adjusting journal entries. Number 85, a company made no adjusting entry for accrued and unpaid employee wages of $28,000. So what they didn't do on 12/31. On 12/31, they should have debited salaries expense $28,000 and credited salaries payable $28,000. That's what they should have done on 12/31, but they didn't do that. They didn't do that. They did not make that adjusting journal entry. So because they didn't do that, expenses were understated. Expenses are lower than what they should be, means net income is higher than what it should be. Okay, so let me write that down. They didn't do this. They should have debited salaries expense $28,000 and credited salaries payable $28,000. They should have done that, but they didn't do that. And because they didn't, expenses were lower by $28,000. Expenses are lower, income is higher by $28,000. So it overstates net income. It has nothing to do with assets. You see anything to do with assets over here? Nope. And it does have an effect on net income, as I just explained that. It wouldn't understate it, it would overstate it because you didn't record the expense. Okay? Look at number 94. So it says on June 30th of the current calendar year, Apricot paid $7,500 for management services to be performed over a 2-year period. So I wrote down the journal entry on 6/30. So on 6/30, what they would have done was debit prepaid management expenses, $7,500. It's a prepaid expense, and then credit cash $7,500. Apricot follows the policy of recording all prepaid expenses to the asset account, which is what I did right there. Okay? The adjusting journal entry on 12/31, this is just like the prepaid insurance policy. Well, we have to take our $7,500, and this is for 2 years divided by 24 months. 2 years, 24 months gives us $312.50 per month. And then you can see we've got July, August, July through December is 6 months. So times 6 gives us $1,875. So therefore we would debit expenses for $1,875 and then credit the prepaid for $1,875. So debit management services expense, $1,875, and then credit prepaid management services expense, $1,875. That would be the journal entry right over here. Okay, and so sometimes writing out the journal entry or thinking about the entire journal entry will help you choose the right multiple choice question. Okay, so we basically have to recognize that 6 months worth of our prepaid management services policy has expired. And how do we do that? With a credit to that asset and then a debit to the expense, just like we did with the insurance policy and supplies. Same idea. Okay? So what I want you to do now is, looking at these pages, I want you to pause the lecture video and do number 97 and number 108 right over here. And then I want you to do 112 and 116. And then come back and let's check it. Okay? Okay, hello and welcome back. So let's look at number 97. The total amount of depreciation recorded against an asset or group of assets during the entire time the asset or assets have been owned. That's accumulated depreciation B. Okay. Number 108, our company PPW company leased a portion of its store to another company for 8 months beginning on October 1st at a monthly rate of $800. Okay. This company paid the entire amount, $6,400 cash, on October 1st. So on October 1st, PPW recorded that as unearned revenue. So on October 1st, PPW debited cash $6,400 and credited unearned revenue $6,400. That's what they did on October 1st. I'll write that down. So on 10/1, debit to cash, credit unearned revenue $6,400. That's what they did on 10/1. Okay? Now on 12/31, we have to do an adjusted journal entry, we being PPW, to record 3 months worth of revenue, right? Because we've earned 3 months worth of revenue. How do we earn revenue in terms of rent, do you think? Well, time has expired. They've occupied that space for 3 months, which means we've earned or provided that rent service. We provided that service to our tenants for 3 months. So therefore we've earned 3 months worth of rent revenue. Okay. So how do we do that in terms of our journal entry on 12/31? We have to do that on 12/31, our adjusted journal entry, to recognize that revenue in the period in which we earned it. We take our $800, which is our monthly rate, times the 3 months, gives us $2,400. We debit our unearned rent revenue, which we credited up here, by $2,400, so it goes down. We're debiting that liability to reduce the liability because we provided the service. And then we recognize 3 months worth of rent revenue by crediting rent earned, $2,400. The right answer is D. As I've said a couple times now, the best way to solve these problems is to write out the full journal entry and then let that help you choose the multiple choice answer. Okay? So let's look at numbers 112 and 116. So it says a company pays each of its 2 office employees each Friday at the rate of $100 per day for a 5-day week that begins on Monday. If the monthly accounting period ends Tuesday, and the employees worked on Monday and Tuesday, so they worked 2 days, 2 employees, $100 a day. So that means $200, so that's $200 per day, because it's 2 employees, and they each get $100 a day. So that's $200 for Monday, $200 for Tuesday, $400 total. We have to look at our month-end adjusted journal entry to record salaries that they have earned, but we have not yet paid them. That's the example that we did earlier in the notes, where we debited salaries expense and we credited salaries payable for $400. Okay? Let's look at number 116. A company purchased a truck at a cost of $42,000 on July 1st. The truck is estimated to have a useful life of 6 years, a salvage value of $3,000. The company uses straight line. This is the method that we talked about earlier in the lecture video, where we take the asset cost minus the salvage value divided by the useful life. So asset cost minus salvage value divided by useful life gives me $6,500. This is $6,500 per year, though, right? This is $6,500 per year. The thing is they started it, they purchased it on July 1st, so it's really 6 months. July 1st through December 31st is 6 months. This is for the full year, so I have to multiply it times 1/2, times 0.5, and that gives me $3,250. That's how much they would record. And then you can see my journal entry, debit depreciation expense, $3,250, and credit accumulated depreciation, $3,250. Okay? Let's look at 130 and 141. Well, I'll do 130 for you, or with you, and then I'll let you do, well, I'll do both these. We'll do both these together, okay? So we look at supplies. We're going to do our supplies T account. So it says the balance in T tax services office supplies on February 1st and February 28th was $1,200, February 1st, $375 on the 28th. Okay, so I'm going to put that, remember, T accounts, debits on the left, credits on the right. This is a debit balance. How do I know that? It's because it's an asset. I got $375 at the ending, so I draw my line, then I have my ending down there. It says, if office supplies expense was $1,900, how much did they purchase? Well, what is the journal entry to recognize office supplies expense? Debit supplies, expense, $1,900, right? And then credit to supplies, $1,900. So if I think about my supplies T account, I've got my $1,900 over there. So then what I'm looking for, if I think about what's the journal entry to record that we purchased supplies, well, it's debit supplies and then credit cash. So it's a debit to supplies. So I have purchased over here. That's my unknown, X. So what I can do is I can say 1,200 plus X minus 1,900 equals 375. I can set up an algebra equation to solve that problem. And when you solve for X, which is your purchased, you get A, 1,075. Okay? So let's look at this last problem here. December 1st, Miller Company borrowed $300,000, 8% annual interest from the bank. They have 60 days before. What's the adjusting journal entry on December 31st? So we take our $300,000 principal times our annual interest rate times the fraction of the year, 30 days times 360 gives us 30. And then what we have is B, debit interest expense, credit to interest payable, just like what we did earlier in one of the earlier lecture videos. Okay? Thanks so much. I'll see you soon.